will be helping with translating for the questions, just to give Dr. Zhao a chance with the translation and getting the interpretation correct. So that should help us. Our next speaker is Carl Dobler. He's with Tega Forest Products. He's going to give us the export perspective of China. So it's slightly different from the import side. Carl has been with Tega, well, I should start again. Carl has over 20 years experience in operations in sales in North American wood products. Carl is the export sales manager with Tega Building Products, which is the leading independent wholesale distributor of building products in Canada and is a major exporter of lumber to China. Carl will address some of the key trends related to the export of North American lumber and logs to China, as well as his outlook on the new normal. So please welcome Carl to the podium.
I've got 42 slides in 22 minutes, so I've got to get going. So my name is Carl Dobler. I'm with Tega Building Products. I'm the export manager. We are a publicly traded company in Canada. We've got 15 operations and throughout the country, 3 treating facilities, 2 in California and 6 in the Northeast U.S. And obviously we export to China, Middle East, and Central America. We're publicly traded on a stock exchange. So thoughts on the Chinese market. Xi Jinping says the economic risks are not that scary. And an APEC meeting recently said that the slower growth is a new normal. So let's see what defines new normal going forward with the comments in the slides coming up. So the contents of my presentation is going to indicate the Chinese economic overview, the real estate market, the log and lumber situation, and a new initiative called the One Belt, One Road, which I'll get into at the end. So for the economic overview, the government's moving away from an export and real estate-based economy to a consumption-based economy and focusing internally and now west on building physical transportation infrastructure to support a new industrial base. So there'll be more on this later. Government investment in the market will continue to decrease as the private sector is given a wider berth, and monetary policy will continue to become unfavorable for its export-based industries as the renminbi continues to strengthen. So the first half of this decade is a transitionary period for China, especially with wood products in terms of moving from an emerging market to an early mature market. So very basic graph. I don't think a lot of people disagree with me on this, but 2008 to 2013, extreme growth phase. Now we're entering a mature market phase, and the technical data from 2010 supports this. So this is the cycle. Loose monetary policy in the last 12 years from 2013 to 2015. Real estate investment up, building activity is up, log and lumber imports up. No surprise here. So now what we're running into is tight monetary policy, real estate investments down, and building activity is down. Again, no surprise here from for sure. So where is the market heading? Although monetary policies are changed to support real estate, the market's not going to bounce back. It's pretty clear. Most likely, it's going to hit softly and land flat. Urbanization rate's already at 57%, so there's not much room for another crazy building era. I'll talk a little bit more about this on another slide. The population structure is changing. China's getting old. Demand's going to be limited on new property. The government's real hope is to change the real estate market from policy-driven to market-driven. And the fiber source is still in shortage, which we've seen in previous presentations today. So demand will be stable after the market settles down. So HSBC has recently quoted that weaker economic activity will warrant further monetary easing. And monetary easing is something that's just coming up all the time. So the People's Bank of China, this is the China Central Bank, they've eased home purchase policy, reducing down payments for second homes to 40%. And I've actually been corrected on this by a number of people here, in that it's actually down to 20% in some cities now. And so to improve lending market to promote healthy development in real estate. Ministry of Finance released a separate statement that will ease taxation on home sales. This is a big one for the speculators that were worried about new taxation on home sales. So the government zoo from the People's Bank of China said the growth rates have fallen a bit too much. So again, they're saying monetary easing. The nation needs more vigilant about inflation and is watching the downward trend of global economy and declining commodity prices. Another advisor said that further policy easing is required. So you can see the combination right here. A really love this index, the PMI, the Purchasing Managers Index. At the 50 here, right here, that's a balance. That's balanced. So if the number is over 50, there's an increasing rate of growth. If it's below 50, it's a contractual growth or a contradiction growth. So as you can see, from 2009, the numbers always bounce below 50, and then you can see there's a bearish triangle heading into the next 2 years. So this is the key indicator to watch, I think, because the Western banks put out this number, and so does the People's Bank of China. Sometimes the numbers are different, sometimes they're the same, but it's one of the only metrics where we can judge from an outside perspective on actually what's being consumed. I'm not going to talk about the Shanghai Bull Run. Someone else, I believe, is going to talk a bit more about this, but you can see since the beginning of 2015, there's been a fundamental increase in equities, which gets me on to my next part, which is the real estate outlook. So is there a shift to equities? Due to the overstock situation, real estate is no longer a desirable investment. That's a pretty bold statement, but it's just a general statement from my perspective. Fewer young people are looking to purchase apartments as they are A, too expensive in Tier 1 cities, the Beijing, Shanghai, Guangzhou, and then in Tier 2 cities, there's too much supply. So generally the sentiment is that too much of the GDP is in fixed investments. So it's risky for people transitioning their money, risky for people in the real estate market, so they're transitioning their money into equities. So here's an example. U.S. real estate as a percentage of GDP was at 6% in 2008. Canada right now is at 7%, and the Economist just recently came out saying that the Canadian market could be overvalued as much as 35%. I think that's very high, but nonetheless they said it. So in 2000, in China, real estate accounted for 5% of GDP. Now by 2012, it rose to 15%, according to IMF. So these aren't apples-to-apples systems. The Chinese real estate market is not the same as the North American real estate market. But when you tie up 50% of your GDP in long-term investments, the other 85% has to maintain that short-term cash cycle in order to keep up to the growth rate. So I think it's very significant. So the real estate outlook for China continued. The laws and policies are constantly changing to adapt to the market. Previously, wealthy families bought investment properties. Then the law changed to one person, one property. Now that law has been rescinded. So it's constantly changing. So there's a heavy adjustment period expected by the end of the decade, and the severity of the decline is based largely on the central monetary policy and how they're going to adapt to it as the market changes. But the majority of the market now is first-time home buyers, and the home improvement market is something that's starting to become substantial because speculators are fearing future property tax, which is still unknown. So the urbanization in China, there's a lot of data here, but the main one to look at is China mainland, 13% in 1953, getting to more modern times, we're 26 to 36% by 2000. By 2013, we're 53% urbanization, and so from 2010 to 2025, Ministry of Housing said that there's 300 million rural population moving into the cities. So by the end of this decade, they expect the urbanization of China to be at 60%. So from now until then, an increase of, let's say, about 5 to 7%. So it's topping out to a mature market. So let's get on to logs. Very generally here, 2012, 2013 were good markets for logs. Average log inventory was 2.5 million cubic meters. At the end of the year, the inventory dipped to a record low of 2 million cubic meters, and the prices increased as a result in 2014. So in only 3 months in 2014, prices went from a very high 164 per cube down to about 118 per cube. And I'm talking very general numbers here from many different countries, especially North America and specifically. So in the summer of 2014, log inventories had rose to 4.5 million cubes. By the end of the year, they got reduced slightly to about 3.5 million cubes. The tentative market, there were still bookings and chartering vessels, but there was a bit tenuous. So going into 2015, a lot of pressure on log pricing. Quarter one was a bit slow. We did a vessel, and it was very tight. But now going into Q2, Q3 2015, very geopolitical issues with supplying countries, there's going to be some issues. So a stable market in China, from what I've heard, is 3 to 3.5 million cubic meters. So internal consumption still needs to outpace imports into the summer before we can find any possible reason for a price increase. That's just my opinion. But with what's going on and the volume here, China logs imports. So by it goes to 2013, so 2014 data was quite accurate, I don't think, but they're about $5 billion US, and about 30 million cubic meters. So the same chart with a bit more data, we've got what Mr. Herbert was talking about this morning with the Russian tax in around 2006, 2008. So you've got a decline of the Russian exports to China, and then New Zealand took up the charge there in blue, and then the U.S. started kicking in 2011, and then Canada's been around since 2011, which is restricted by policy, government policy, for the most part. So we're looking now at U.S. log exports to the world, and so just look at it the other way around. $2.5 billion per year. And you can see from 2009, we're hitting an average of 1.5 billion, going to 2.5. So that whole billion is being made up clearly by China. So this is a massive market for U.S. log exports. Japan exports to Canada and to South Korea, very consistent for the last 12 years. Now this is Canada log exports. So we're hitting the $800 million range. It's a smaller industry, again, completely policy-driven, government policy-driven. We export log packs and so forth. But again, since 2010, we see an increase in growth of exports, plateauing in 2013, 2014, and again, Japan very consistent. United States is consistent at a small level since 2009. Everyone likes this slide. It's log fumigation and high-time port. So that's bar's on product. They just throw charcoal over it, handle chemical into it, and it's fumigated. So don't stand up for this. So here's some pricing numbers. Some guys may agree or disagree with the exact numbers, but I think it's pretty close. So this is a quarterly figure. And so 2013, quarter 1 to quarter 4, we've got an increase of to about 160 per cube. And a drop, as I was saying, in 2014 of about 130, which is a pretty accurate number from personal experience. So now, where are we at? So the blue line here is bigger. So here's the range of Canadian offerings right now. 110 to 125, probably in that lower range now. So average cost at the port right now, 120 to 125 is what I'm hearing. Price of in-transit shipments, 110 to 120. And then the offerings from New Zealand and Australia are $95 to $110. So it's very, very low. And I mean, a lot of people like themselves last year were buying here $100 and adding $40 straight. So you can see the difference happening. So quick log outlook by country. Sir Herbert spoke on the Russia volume, so I'm not going to get into that. But to be honest, the ruble across a massive inflow of logs, which is slowly going back. The ruble's still weak, and there's still massive volumes in harness. Cons of lack of infrastructure, export tax. And the ruble was, January 31st, 11, it took 11 by 1 RMB, now it's 8.2, so it is coming back. New Zealand volume, more mature forest coming into the decade, but lack of infrastructure and skilled labor within what's coming up. Radiata pine still remains at a discount to more desirable North American species such as emerald and Northwest, U.S. and Canada. U.S. volumes, let's split it up in the Northwest and Southern pine. Doug for Hemfer depends on domestic economy and demand. I really think, and again, it's a personal opinion, but in the next few months, we're at a threshold of where the Canadians or the Americans will probably want to be selling more domestically than export-wise, just because of the numbers I'm seeing for export. Southern yellow pine plantations, I'm not too familiar with this, but we do export some logs out of the south. And I do see, I've heard of a collective logs coming to the market in the next 6 years, just due to the plantation. Native volume, this is an export bid system, so it's going to continue to supply an abated volume to the market. And this has been unchanged for many years. So I don't see a policy change in sight, unless someone can correct me on that. So Canada is still expected to remain number 4 for log exports to China, which is driven by the 3-gauge coastal producers. Seen this chart before, so the 3 China ports inland over China, Manzhouli, the big one, Sufenhe, which is by Vladivostok, and then Haote, really affected the pricing in northern China, especially Dalian, Tianjin, and Qingdao. So the scale of locked supply predictions, Russia, that's been answered. There's still a big question mark. I see a surplus of volumes coming out of Southeast USA in the short term and the long term. I'm predicting that domestic consumption will probably start to increase with the Northwest. And with New Zealand, the infrastructure is going to remain flat, and the policy-driven DC is going to remain flat for exports. So getting on to lumber. This was the containers that are not export packs, sorry. Notes on lumber market. 2014 was a good year. I don't think anybody will disagree with me on that. Prices were good, volumes were good, maybe not great. Not too much to complain about. 3.6 billion China imported US dollars in 2014 under the harmonized code of 440710. But things changed quickly in 2015. Decline of oil, plus 10% valuation of the US dollar, reduced purchasing power globally, et cetera, et cetera. So long term, North American exports are expected to decline by 5 to 10% by the end of the decade. And this is predicted to be mostly due to the delay of increased U.S. housing demand and decreased availability of Western SPI. So here's China lumber imports. You can see we're hitting $3.5 billion here. Steady growth rate, good at Jag here, and in 2013, 2014, very similar, about 3.5 million. And we expect that to settle out at that level. But I took this the dollar against the cubic meters going into China to get an average dollars per cubic meter landed. And you can see there's an extreme growth rate in demand, but pricing is remaining fairly not on the same type of increase, obviously. So we're kind of tapering out to $200 per cubic meter. And that's probably going to be a pretty strong threshold if we're going to continue to supply concrete forming to the market without any value-added products. And as a comparable, the number for North America is more like $225 per cube, I would say, on average. And then for domestic consumption, probably the 275 range, just as a comparable. So, so same chart, except dropped it out by U.S. and Canadian imports. So U.S. very strong again last year. Canadian imports showed a decline, but actually, if you look at it in Canadian dollars, it went up by $20 million, but converted to U.S. dollars, it actually shows that it went down a little bit in 2014. This is now we look at it from the opposite side of it. U.S. number of exports to the world. So again, Canada very consistent, Mexico very consistent, and China growing since 2009. The harmonized codes for exports don't segregate by species. So these two items here are, these two items here are all species. So, I know the duck fur and the hemp fur have been difficult exports over the last year, specifically, so I'm predicting that the increase in that is mostly due to southern Ohio. So from a Canadian lumber export perspective, we're hitting $8 billion in 2014. But this chart is pretty clear to me. Like, if you look at the red, it's China. China's pretty consistent on dollar-wise from 2010 all the way to 2014. Japan's a very consistent market. But really what's bringing everything back in terms of more production capacity will be the U.S. There's just no question. So, we love to talk about China. It's a great market. But in terms of the volume available, it's just going to tap out a little bit here. Taking out the dollar value, if you look at cubic meters, it's a little bit more of a flat curve. But you've got, again, very consistent exports to China from Canada from 2010 onwards. Again, in Japan, the growth is in the United States. And plus the returns are a lot better, probably by to a factor of $50 to $70 per cubic meter. So the last thing I'm going to talk about is this new initiative called the One Belt, One Road. It has a number of names, the New Silk Road or the Marshall Plan. So with the New Silk Road, it's One Belt, One Road. It's a strategic Eurasia land and sea transport corridor. The Silk Road economic belt is in red, and basically that follows the old Silk Road. It starts in Xi'an and goes through Xinjiang, and then goes into the Central Asia, through the Middle East and into Europe. The Maritime Silk Road, as you can see in the blue, it covers the South China Sea, the Bay of Bengal, and the Arabian Sea. So if you notice in the last month, President Xi in China has been in Pakistan. And the reason for that is, if you look at that pink arrow, this pink arrow right here, That's from Xinjiang to Guadalajara port. That is the shortest distance from China to the Arabian Sea, which will get them into Middle East and Africa. So that's going to be a major push for China initially on this One Belt One Road initiative. So what is it? It's roads, railways, ports, and airports. It's all infrastructure related. But the one thing that China is really pushing, and you've seen this lately with the renminbi, is that they want to create the renminbi as a transactional currency. They want to denominate bonds in renminbi. So they're looking at their strategic countries and partners to partner with them on renminbi-backed bonds and swap arrangements with other banks. And you can see that recently with ICBC Bank in China, they've allowed Vancouver and Toronto to become a de facto currency with the renminbi. So should Obama be worried? Absolutely. This is a very big initiative, and there's a lot here to talk about, but basically, the Silk Road Fund is $40 billion. China's reserves are $44 trillion, so that's only 4% of their total reserves. So for them to throw this much money at it is really nothing. Geographically, it's as far away from the U.S. as possible, so it's going to be tough for the contractors to get there. Mr. Xi's vision of the free trade area of the APP is bigger than the Trans-Pacific Partnership. So there's a little bit of that headroom over there. So many primary vendors now are actually supplying China. I read this in Congress the other day. They're supplying China for secondary manufacture. So China's leaning on them to trade in renminbi and to lean on them to support them with this One Belt One Road initiative. So there's a lot of synergies post-World War II with the U.S. and as a win-win situation. So the new institutions also have greater voting shares than the U.S. do for contracts. So there is a reason Washington is lobbying against this. And these are only some of them. So who cares though? What does wood benefit from? Really, again, right? That's what we're all asking. So it's a very new initiative, so I'm not going to make any predictions, but it's easy to predict that it's not a value-added market initiative when related to wood products. It's all concrete-based structures, bridges, rails, ports, and buildings. So will it mark the second run of fiber into China? I'm not going to answer that, but it definitely I'll be able to see in Xinjiang or somewhere in the west where there's going to be some infrastructure in place. So in conclusion, it's clear that China log lumber demand is transitioning from an emerging growth market to an early stage mature market, which is supported by technical data and overall growth, cooling growth to 7%. Fundamentals point to cleaning up of the banking system, which we could talk about a bit more, but it's going to result in a more dynamic free trade market, but in the short term, there's a lot of uncertainty and risk. So again, the overall demand for fiber in North America will likely weaken from 0 to 10% by the end of the decade. And last comment, general one, as China keeps growing the world's leading economic power, demand is still huge, which we've heard before. The question is still where will they source the fiber and who is able or willing to provide a more competitive fiber source, which is right now the lowest price, especially when currency factors will start playing an increasingly role in trade with China.